Hi there, I'm Shay with Principal. Wherever you're joining me from, I'm glad you're here. When it comes to money, women should consider investing in a way that fits our lifestyle and future goals. It's important for women to factor in potential career breaks and pay gaps, longer average lifespans, and potentially higher healthcare costs in retirement. These factors mean we may need our savings to last longer. So, how can you help make your money work harder for you? Investing may help. Whether you're just getting started, you're already investing but want to see if you're on track to meet your goals, or you're nearing retirement and want to make a smooth transition, today we'll talk about investing considerations for women during each life stage. First, we'll watch a short video, then we'll get back together after to answer some top questions around investing, such as checking to see if your investments are diversified, how to determine if your savings will last throughout retirement, and understanding the basics of IRAs. If you have questions of your own, you can submit them anytime using the Q&A feature. We'll answer your questions as they come in. After today's event concludes, we'll send out an email with a link to watch the webinar replay. So enjoy the video and let's get started.
Whether you're getting ready to retire or just starting out in your career, planning for your financial future is important, especially for women. That's because throughout their careers, women typically earn less money than their male counterparts, so they often end up with less retirement savings than men. And women tend to live longer than men, which means the risk of outliving your savings is a real possibility. One way to help build your savings and help feel more secure in retirement is to invest, and you don't have to be an expert to get started. If you feel overwhelmed by the thought of it, you're not alone. Investing is one of our most requested education topics, and it's the second most requested topic by women. Maybe you'd like help getting started and learning about your options. Perhaps you're already investing but want to make sure you're on track to meet your goals. Or maybe you're nearing retirement and want to make a smooth transition. In the next few minutes, you'll learn ways to make investing work for you and your goals in every life stage. Let's begin with those who are just starting in their investing journey. Then we'll dive into more advanced strategies. Congratulations! You've decided it's a good time to start investing. Whether you've just graduated from college or an apprentice program and you're starting your first job, or you've been working for a while and decided it's time to invest, making the decision is a great first step. One common question is, why should I invest? Saving your money usually means putting it in a traditional bank account or storing it someplace safe. When saving with a traditional bank account, your opportunity for growth is typically low. On the other hand, when you invest, you're purchasing financial products and keeping your money in a specified investment account. Investing may help you beat inflation by earning interest, outgrowing the inflation rate, and that helps ensure your money's purchasing power stays strong. When deciding how to invest, it's important to ask yourself why you're investing. Many people invest to help achieve a goal. Keep in mind, investing can be better suited for longer-term financial goals, like funding your future home or building your retirement nest egg. Saving, on the other hand, can be a good way to reach short-term goals, like paying off credit card debt or buying a car. It may help to put pen to paper when thinking about your financial goals and how to reach them. Studies show when you write down your goals, you're 42% more likely to achieve them. Our handy Financial Goals worksheet can help you get started. In addition to investing to reach a goal, many people use their investments to align their values with their financial decisions. Maybe there's an organization that's near and dear to you that you want to support, so you decide to invest in them. Or maybe you choose to invest in and support companies whose mission and values resonate with you. Once you've determined your goals and your financial values, it's important to learn about the many investment options available to you. One of the most common places people start investing is in a retirement plan, like a 401k, 403b, or an IRA. In fact, 70% of women are enrolled in these types of plans. Investing in a retirement plan early, like a 401k, 403b, or an IRA, can help you build the habit of saving into your daily life. And it gives your money the opportunity to grow thanks to compound earnings. Compound earnings work like this. As your investment grows over time, the money gained, in the form of dividends or capital gains, is reinvested to purchase additional shares or units of that investment. When it's reinvested, there's more shares or units that have the potential to grow and multiply over time. For example, stuffing $25 a week into a jar for 30 years would get you $39,000, while investing that same amount at a 6% annual rate of return plus compound earnings could help that investment grow to more than $105,000 in the same time. If you're participating in your employer's retirement plan, check to see if your employer offers a contribution match. Many employers will match a percentage of their employees' retirement plan contributions as part of their benefits. It's a good idea to contribute at least as much as your employer's match because it's more money in your account at no cost to you. If you haven't enrolled in your employer's plan yet, you can get started today at Principal.com/welcome. Already enrolled? Make sure you're taking advantage of your employer match by logging on to Principal.com and managing your contribution amount. Beyond employer retirement plans, another common place women choose to invest is in an individual retirement account, also called an IRA. You can contribute to a Roth or traditional IRA even if you participate in an employer-sponsored retirement plan. The main difference between an IRA and a 401k is that the IRA belongs to you individually. It's not tied to your employer, so you can have more freedom to invest when and how you want. But remember, you'll need to choose your IRA investments. Otherwise, your money is not being invested. It's just sitting in the account. Should you consider an IRA? That depends. Here are a few questions to ask yourself. Do I want to save money that's not tied to my job? Do I want to save in addition to my 401k? Will I be changing jobs again and have another retirement account? Would I benefit from consolidating my accounts if I leave my current employment? If you answered yes to one or more of these questions, it may be a good idea to learn more at Principal.com/IRA basics and to talk to a financial professional about whether an IRA may work for you. We can help you find a financial professional near you at Principal.com. Another important thing to consider is your tolerance for risk with your investments. It's important to understand your comfort level with risk because healthy markets typically go up and down hourly, daily, or weekly. Those with a higher tolerance for risk are more comfortable knowing they could lose money in the short term if there are potential gains in the long run. Others with a lower tolerance for risk are willing to forego potential higher gains if it means they could potentially lose less. When choosing your investments, it's good to remember that the higher the potential for return, meaning a gain on investment, the higher the potential for risk of loss, and vice versa. Curious about your risk tolerance? Take our simple investor profile quiz to find out what kind of investment mix may work best for you. Maybe you started investing a few years ago and you've got a solid foundation. Nice job! Now you'd like to work on building a solid financial future as you advance your career, expand your family, or make other life changes. That means learning more about diversification and asset allocation, as well as checking to see if your risk tolerance is changing as your life is changing. Since you began your career, you've likely experienced some significant life changes. It makes sense then that your risk tolerance might have changed too. The Investor Profile Quiz at Principal.com can help you see where you stand now. If you took the quiz previously, we've saved the results so you can compare. If your risk tolerance has changed, you may want to consider adjusting your investment mix. Keep in mind, if you're investing in a target date fund, those automatically adjust over time to be more conservative as you get closer to retirement. Most days, your investments probably aren't top of mind, we get it. But it is a good idea to check in regularly to see if you're making progress toward your financial goals. One way to see if your savings are keeping up with your retirement goals is to check your retirement wellness score at Principal.com/myscore. If your score is red or yellow, you may want to consider increasing your contribution amount. If your score is green, you're doing great. Keep up the good work. While you're at it, this is a great time to consider adding new financial goals to your list. For example, if you have a young child, maybe you have the goal of helping pay for higher education in the future. So investing in a college savings plan might be something you want to look into. It's always a good idea to check in on your goals regularly and update them as your priorities change. Next up, for those looking to increase their investing knowledge, let's talk about diversification. Diversifying your portfolio means that you spread out the funds in your portfolio across different types of investments to help manage risk. For example, if Ava puts all of their money in one investment option and that investment falls in value, the total value of their investments will decrease. Their entire account is dependent upon the performance of that single investment option. However, if Ava diversifies their money across multiple investments, they may be able to reduce their investment losses because while one investment may suffer a loss of value, those losses may be offset by gains in other investments. The most common way that people help reduce their investment risk is to invest their money in mutual funds or exchange-traded funds, ETFs. Both options typically have a large number of stocks and other investment options within the fund, which makes them more diversified than investing in a single stock. These are what you will find in most employer-sponsored retirement plans. Asset allocation involves dividing your investment portfolio among different asset classes, like different types of stocks and bonds. This helps further reduce the risk of losses should one asset class experience losses. Now that we've covered the basics for those just starting out, and diversification and asset allocation for those needing to make updates, let's talk about a later stage in your investing life, nearing retirement. One of the most important things to remember during this time is to focus on what you can control, especially during periods of market volatility. The best way to avoid making emotional decisions during market ups and downs is to stay focused on your goals and your timeline. The Retirement Savings Checklist can help you think about what you may need in retirement to live the life you want. Concentrating on the things you can control can also help you take your focus off the short-term market changes by taking steps to meet your larger goal. For example, you can adjust how much you're contributing to your retirement and the amount of risk you're taking. See how financially ready you may be for retirement by checking your retirement wellness score. Visit Principal.com/myscore to see yours. After you've checked your score, consider the fact that women generally have a longer life expectancy than men, almost 5 years longer based on the most recent data. Knowing this may make you rethink the amount you've saved for retirement. The good news is, there's still time to make changes that could help you in retirement. If you'd like to build your savings, consider increasing the amount you put in your retirement account with each paycheck. Or an even better option may be to have your deferral automatically increase over time if your employer offers that feature. Another way to save more for those nearing retirement is to make catch-up contributions to your employer's retirement plan, if allowed by their plan. If you've maxed out your retirement savings contribution amount and you're over age 50, you can make catch-up contributions. For 2022, that amount is $6,500 for accounts like a 401k, 403b, and 457b, while IRA catch-up contributions hold steady at $1,000. As you near retirement, it's important to review your asset allocations. Maybe you want to continue to hold higher proportions of stock in the hopes of capturing potential growth if you still have several years until retirement. Or maybe as you get closer to retirement age and think about accessing your money soon, you want to allocate your funds to more conservative investment options to help minimize the risk of losing the growth you've gained. Make sure to review your portfolio at least annually to make sure your investment mix aligns with your changing goals and risk tolerance. One important thing to note for all life stages: it may be beneficial for you to find a financial professional you trust that can work with you. They can answer your investment questions as they come up and help you identify how certain investment options may work best for your goals. If you need help finding a financial professional, visit Principal.com. As you've learned, women may need to start saving as much as they can, as early as possible, to live the life they want in retirement. Whether you're just starting to invest, have updates to your current investments, or you're nearing retirement, your investment goals will most likely change as your life changes. The knowledge you've gained today will help make sure your investment goals are aligned throughout your different life stages. Start by applying your knowledge now. Log into your account at Principal.com to check your contributions, check your retirement wellness score, and see if you're on track to meet your goals.
Welcome back. I hope you enjoyed the video. Now let's get into the questions. Our first question today is, I'm investing in a 401k. What's the benefit in also investing in an IRA? That's a great start. An IRA is just another way to help save for retirement. Instead of the account being tied to your employer, like a 401k or 403b is, it's your own account. So you have more flexibility with when and how you contribute to it. And even if you change jobs, that account stays with you. IRAs also give you access to a broad range of investment options, not just what's offered through your employer's retirement plan. It's important to know that depending on what type of IRA you have, either a traditional or a Roth, you'll still be taxed on the funds. For a traditional IRA, you'll be taxed when you withdraw the funds. And for a Roth IRA, you've already paid taxes before you contribute money into your account. If you're interested in learning more about IRAs, check out Principal.com/IRA basics. Our next question is, I'm planning on retiring but may not need to withdraw from my savings quite yet. Is there anything I should keep in mind when it comes to my retirement assets? This is a great question. If you're retiring soon, but you may not need to withdraw from your savings right away, you could leave your funds in your retirement account to keep taking advantage of any potential gains. The longer you have your money in your retirement account, the longer it stays invested. But be sure to review your risk tolerance as your life changes. A financial professional can help you navigate your investment options and help determine what would be best for you and your situation. Next up, we have, is there anything I should consider to see if my savings will last in retirement? A good place to start is by using your retirement wellness score. This will help determine if you're on track to meet your savings goals. You can check your score at Principal.com/score. The number you see is the percentage of pre-retirement income you're estimated to be able to replace in retirement. Aim for a score of 80 or higher. The first important thing to remember is the sooner you start investing, the more potential your money has to grow over time, taking advantage of any compound earnings. The second is to set and maintain your investment options to align with your goals, keeping your long game in mind. Also, if you're getting closer to retirement, you could also consider taking up a part-time job for extra income, maintain a 4% withdrawal rate, this may also help your savings last longer, and consider waiting to take Social Security until you reach your full retirement age or later. That will help maximize that monthly benefit. Our next question today is, how do I know if my investments are diversified? You can check to see if your investments are diversified by logging into your account at Principal.com. From your account dashboard, click the Investments dropdown and select Investment Summary. From there, you'll see your investment mix. If you see a mix of investments in different asset classes, your account is diversified. If you're not seeing a mix of these, you may want to take the Investor Profile Quiz at Principal.com/Investor Profile Quiz. This will help you learn your risk tolerance and what mix of asset classes may be right for you. It's important to know that the goal of diversification is not necessarily to boost performance. It's not going to ensure gains or guarantee against losses. Instead, diversification helps spread out your investment dollars across a range of assets to help reduce risk. For example, by choosing not to put all your eggs in one basket, you help protect your portfolio from market volatility. Our final question today is, Can I decide for myself what investments are in my retirement plan? This depends on the account you have. In a 401k, the choices of your investment offerings are determined by your employer. In an IRA, you get to choose the financial services provider you'll hold your account with, and they typically have different investment options. You could also have the option to delegate the ongoing management of those assets to separate investment managers in both of those accounts. So yes, you can decide for yourself what direction to go. That said, it may be overwhelming to pick various investments and what percentage to allocate to each in your retirement account. So options like a pre-built portfolio or managed accounts may work better if available. It all depends on your comfort and how hands-on you'd like to be. A financial professional can help you determine what may work best for you. That concludes the Q&A portion of today's event. We'll continue answering questions in the queue. Hang tight if you haven't received a response yet. We're doing our best to answer all the questions that are coming in today. What can you do next? If you want to learn your tolerance for risk or see if you've selected the right mix of investment options for yourself, take a moment to answer 8 quick questions at Principal.com/investor profile quiz. The quiz will suggest a mix of asset classes that may be right for you. Then you can check your retirement wellness score to see if you're on track to meet your savings goals. Visit Principal.com/score to get started. If you have more questions or would like some help, a financial professional can help you put together a plan for retirement and your long-term financial goals. Visit Principal.com to search and find one near you. Thanks for tuning in today. We'll send an email with a link to watch the replay if you missed any information. To replay or share this webinar and see a list of upcoming webinars, visit Principal.com/learn-now. You always have 24/7 access to replays. Take care, and we hope you'll join us again soon.